Let's now consider the question, are devaluations contractionary? We're going to consider a decline in the value of a domestic currency, noting that when we have a floating exchange rate, this is called a depreciation rather than a devaluation, but for our purposes here, the basic logic will be the same. Let's say the country in question is the United States and the export is wheat. We want to look at the total funds directed toward the purchase of wheat, or P times Q. And what we see here is that the relative price which foreigners face for wheat is now lower because the dollar is weaker. But at the same time, the price which U.S. suppliers are receiving, measured in terms of dollars, that's the same. So if sellers are receiving the same amount of dollars, the Q they are selling has gone up, and that means P times Q, price times the quantity. There is more revenue being directed toward the wheat exporting sector, and that will mean higher output and more jobs. But in general, having to spend more on imports should be considered a contractionary effect, and its costs are often highest in the short run. Let's now consider our imports, where the decline in the value of the currency may not be expansionary at all. So let's say it's Americans who are buying mozzarella cheese from Italy. The dollar is now worth less by assumption, so if we go back to our P times Q for mozzarella cheese, we see that the real price Americans have to pay for mozzarella cheese has gone up. Of course, over time, the quantity of that cheese purchased will go down, so with P up and Q down, P times Q can be either going up or going down. So in terms of the net flow of funds coming in and out of the United States, it could be the case that we are now sending more funds abroad, and in this regard, the higher price we're paying for imports can be contractionary instead of expansionary. So we have that export sector where the decline in the value of the US dollar definitely helped, but then we're paying back some penalty on our imports, and the net effect is that the lower valued currency may or may not be expansionary as a whole. We need to keep in mind that elasticity of market response with respect to price is typically greater in the long run than in the short run. So that means now that American exports are cheaper, foreign demands for wheat, they'll go up a little bit at first, and then more over time, and over time even further yet. People have had the opportunity to reshape their plans to take advantage of the cheaper wheat. What about that higher price for imports? Well, again, over time, people will adjust more. Americans may say, stop relying so much on cheese from Italy and make more cheese in Vermont, and the contractionary effects of that higher price for cheese will be smaller in the long run. So overall, both effects on the export side and the import side mean that lower value currencies, they might be contractionary in the short run in their effects, but over the long run, it's much more likely the net effect will be expansionary. This is sometimes represented by a so-called J-curve, which has time on the horizontal axis and the balance of trade on the vertical axis. What we see here first is that following a decline in the value of the currency, in the short run, well, the balance of trade is getting worse. That is, this line is sloping downwards. But as those longer run elasticities kick in, this curve will turn upwards, thus the J appellation, and over time the balance of trade will improve. This change in the trade balance over time can be graphed using what is called a J-curve. So for a J-curve, on the horizontal axis we have time, on the vertical axis we have balance of trade, and you can think of this, the 0 point, as being the balance of trade being in perfect balance. Above that is surplus, below that is deficit. So when you have a lower valued currency, what may happen in the short run is that actually your trade balance. There's a technical way of writing the conditions under which the lower valued currency will improve the overall balance of trade. Those are called the Marshall-Lerner conditions, and they relate fundamentally to elasticities, and the Marshall-Lerner conditions state that if the elasticity of exports with respect to the exchange rate plus the absolute value of the elasticity of imports is greater than 1, then the conditions are satisfied, and the lower valued currency will improve the balance of trade and also prove expansionary. There's a technical condition which expresses when a lower valued currency will in fact be expansionary and help your trade. A common problem case for a lower valued currency is when a country has to import a lot of oil. In that case, they have to pay more for the oil it may be hard to find good substitutes for the oil, and that oil is also very often an input into the exports of that country, so the more expensive oil will hurt their exports as well. If you're wondering, by the way, what is the most common problem case where a lower valued currency does not prove expansionary, well, quite frequently that's the case of countries which have to buy a lot of oil from abroad. That oil is an input, and it may be very hard for countries to substitute away from that input because energy is very important for production, and perhaps the country has no oil supply of its own, and those are the cases. Note that it's complicated to sort out the effects of the lower valued currency on the balance of trade with other factors. So for instance, a weaker value for the currency could be correlated with negative wealth effects, and it may also mean that in that country there's a loss of confidence or the risk premium has gone up, and both of those will generally be harmful. Empirical tests show that both cases are possible, that a lower valued currency can either prove expansionary or contractionary. I would say in recent times the stress of economists has been on cases where it might do some countries good to have currencies which could fall in value, especially in the Eurozone where you have troubled countries on the periphery, but they are locked into fixed exchange rate systems and they do not have the opportunity to reap some of the exporting benefits of a lower valued currency. Consistent with the theory presented, empirical tests show both cases of lower valued currencies being expansionary and contractionary. Keep in mind that a lower valued currency is typically correlated with a loss of confidence, so it's difficult to separate out the contractionary effects. Well, how many of those actually? To read more on all of these topics, you can start by Googling the terms and mentions listed here.